Jeff Bezos, America's richest man, reportedly paid no federal income taxes between 2007 and 2011. Elon Musk, the second wealthiest person, paid no taxes in 2018. Warren Buffett, who is frequently ranked third, paid a tax rate of 0.1% between 2014 and 2018. Today, we are going to show you ways in which the CEOs pay $0 taxes. Stay tuned till the end for this. If you are new to the channel, please like, share, and do not forget to subscribe to our YouTube channel. Number 5. Fleeing to tax havens. For Tesla, plus 0.5% has a CEO. According to reports on Tuesday, Elon Musk has relocated his primary residence from California to Texas, making Musk, Amazon plus 0.5% CEO Jeff Bezos, and Microsoft minus 0.4% co-founder Bill Gates the 3 richest people in America that live in states that do not collect income tax. Musk's move was expected, as rumors circulated among his friends and associates that the Lone Star State would be his next home. He relocated his private foundation to Austin this summer. Musk, who is worth roughly $140 billion, has previously clashed with California officials over the state's coronavirus restrictions, going so far as to sue Alameda County in May and threaten to relocate his company if its factory is not allowed to reopen. Bezos, worth an estimated $183.3 billion, and Gates, worth an estimated $118.7 billion, both live in Washington state, where their companies were founded. Washington and Texas are 2 of 9 states in the United States that do not collect income taxes. Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, and Wyoming round out the list. According to the Tax Foundation, a leading nonprofit, Tennessee and New Hampshire still tax interest and dividends, but the latter is set to phase out this tax in 2025. Musk, however, is far from the only billionaire to flee to tax havens. After decades of living in his namesake Manhattan Tower, Donald Trump relocated his official residence to Florida in October 2019. Carl Icahn and Paul Singer, both Wall Street titans, relocated their hedge funds to Florida in 2019 and 2020, respectively. Forbes confirmed Icahn resides on the private Indian Creek Island near Miami, where Jared Kushner and Ivanka Trump reportedly recently purchased a $30 million plot of land, making him exempt from state income tax. Tom Golisano, the billionaire founder of Paychex minus 0.2%, claims to save $13,800 per day in taxes simply by relocating from New York to Florida in 2009. Given the enormous income generated by some billionaires, these moves may have a negative impact on state coffers. When hedge fund manager David Tepper relocated from New Jersey to Florida in 2016, the decision appears to have cost the Garden State hundreds of millions of dollars in revenue and disrupted income tax forecasts, raising concerns among state officials. In a Wednesday morning tweet, American hedge fund billionaire John Arnold raised another concern, noting that California's 13.3% capital gains tax, the country's highest, effectively drops to zero the moment high earners like Musk simply decide to leave the state for lower tax locales. Number 4. Buying armies of lobbyists. Power and wealth are inextricably linked. The super-rich have amassed armies of lobbyists in order to keep their taxes as low as possible and to create and maintain tax loopholes large enough to drive their Lamborghinis through. The loopholes are more durable than kryptonite. Remember the infamous carried interest loophole, which nearly every presidential candidate in the last 5 elections has promised to close. It is still present. The wealthy's armies also prevent any major changes in the system that might jeopardize their wealth, such as a wealth tax, stronger unions, or tougher antitrust enforcement. Right now, American democracy is under attack from 2 sides: white supremacist supporters of Donald Trump who are suppressing votes, and wealth supremacists who are bribing lawmakers with campaign contributions. Some wealth supremacists are quietly funding white supremacists because their common enemy is democracy. Hundreds of U.S. corporations and CEOs lent their names to a 2-page ad in the New York Times and the Washington Post in support of voting rights a few weeks ago. Many of these companies and CEOs are also members of the U.S. Chamber of Commerce, a powerful Washington business lobby that recently issued a key vote alert against the For the People Act, which is intended to protect voting rights from state laws that suppress votes as well as moneyed interests buying votes. The hypocrisy is more prevalent than ever. While corporate public relations departments issue noble statements, corporate legislative departments continue issue legislative bribes. Billionaires like Warren Buffett publicly advocate for higher taxes while paying almost nothing privately. Number 3. Income from wealth is taxed differently than income from work. The vast majority of working Americans are paid hourly or on a regular basis. Income taxes are typically deducted automatically in both cases. People with a high net worth, on the other hand, often derive the majority of their income from assets, such as stock holdings, real estate, or other investments, according to Wang. As the value of those assets rises, the stock market rises, pieces in their art collection become more expensive, the real estate market shifts in their favor, so does their total wealth. That income is only taxable if they sell the asset that generated that income, Wang explains. As a result, unlike ordinary wage and salary owners who pay taxable income in real time, very high net worth individuals can choose whether and even when to pay taxes on the growth of their wealth. The current federal income tax rate, at its highest, imposes a tax rate of 37% on individuals earning $523,600 or more and married couples earning $628,300 or more. It's not uncommon for business owners with a high net worth to pay themselves lower salaries in order to avoid the tax rate in this income bracket. For example, Bezos collected just $80,000 per year as the CEO of Amazon. Apple founder Steve Jobs, former CEO of Hewlett-Packard Meg Whitman, Google co-founders Larry Page and Sergey Brin, and Facebook's Zuckerberg all accepted a salary of $1 per year, likely for the same purpose. During the 2020 campaign season, Senators Elizabeth Warren and Bernie Sanders each released their own wealth tax proposals. Implementing a regular wealth tax would finally ensure that wealth income is counted alongside work income. So, while wealthy corporate executives could still reduce their federal income tax by accepting comically low salaries, their existing wealth would be taxed regardless. Warren and Sanders have continued to advocate for the policy, introducing the resurrected Ultra-Millionaire Tax Act with other progressive Democrats in March. President Joe Biden has even proposed using wealth taxes to fund critical social spending programs. Keep watching, there's so much more in store for you. Number 2. Wealth can be converted into spending money and not be taxed. How is income from wealth used to purchase something if it functions and is taxed differently than income from work? How does an asset become spendable money? In a nutshell, wealthy people frequently rely on loans, rather than selling the stocks or real estate, which would be subject to tax, and then using the proceeds to fund their lifestyle. Wang explains, many of these people borrow money and use it to fund their lifestyle. According to Wang, banks are much more willing to offer wealthy people large loans with extremely low interest rates. According to Business Insider, billionaire investor Larry Ellison, for example, used some of his stock shares to open a $9.7 billion line of credit in 2014. Last year, the outlet reported that Musk used a portion of his Tesla stock to secure a $550 million loan. Borrowed money is not taxable because it is not considered income. If a bank looks at someone with a few $1 billion in stocks, or even a few $1 million in stocks, they're very, very low risk, Wang says. As a result, they can fund those lifestyles and enjoy the benefits of that income without having to pay taxes on it. Number 1. Charitable donations. Giving money to nonprofit organizations has long been used by the wealthy to get a tax break. Furthermore, under the new tax law, the amount you can deduct has been increased to 60% of your adjusted gross income, up from 50%. According to Fethergill, who is also the national head of legacy and wealth planning at Abbott Downing in Winston-Salem, North Carolina, one way the wealthy have taken advantage of the deduction is by establishing conservation easements. A large plot of land may be worth something on its own. Perhaps it's a bird migration field. Maybe it's next to a river. Maybe it's some green space in an overdeveloped area. She explained, you can often work with land conservation trusts and take a charitable deduction for the value of the conservation easement that you place on the property. Of course, the average taxpayer can deduct charitable contributions as well, but they face a higher hurdle. They must itemize their taxes in order to do so. The Tax Cuts and Jobs Act nearly doubled the standard deduction to $12,000 for individuals and $24,000 for married couples filing jointly in 2018, requiring itemized deductions to exceed those amounts. That's all we had for today. Hope you found the show informative. Do not forget to give us a like, comment below on the comment section below. Be sure to subscribe and tap on the notification button.